Welcome, this is your Option Monster Volatility Sonar Report. From the floor of the CBOE, this is Jamie Tyrrell of Group 1 Trading. Well, yesterday we touched on the low realized volatility we're seeing in the equity marketplace, and today the S&P 500 sitting exactly on unchanged as I'm speaking today. Yesterday's big trade was people buying downside puts in April and May. We've talked about how the realized volatility is in single digits, the VIX cash about 17, and the back month futures are pricing more at a long-term average for the VIX. They're expecting an increase in volatility just because they believe that this low volatility environment won't continue. We've had some contrary people buying downside puts, expecting that eventually the VIX cash could come lower, more in line with where realized volatility has been. So there's two divergent viewpoints, and today another customer came in buying downside protections in the midterm. They bought the May 17-18 put stupid and the June 17-18 put stupid. That means they bought one May 17, one May 18, one June 17, one June 18. So they got a lot of downside protection there. They paid $3.55, which is an average of just under 90 cents per contract, and they bought 8,000 of each. So that's 32,000 downside contracts bought. So we are seeing more and more divergent viewpoints. That downside stuff really wasn't bid heading into the week, but with the 15s trading and now the 17s and 18s, we're seeing more and more interest in that downside. It's blowing up the downside skew. People are putting more numbers on the downside in play, like 14, 15, 16. Which has more evenly distributed the trading. We usually see a concentration in upside calls, the big spread being call spread 1/2s on the upside. Now we're seeing more action on the downside. It's something we're monitoring and should be interesting to see how it develops going forward. Jamie Tyrrell with Group 1 Option Monster.